The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He needs no introduction. His name is Jim Bianco. Jim, welcome back to the show, my friend.
Well, thanks for having me, George. I think the last time I was on with you was right when everything was hitting the fan last year.
Yeah. It was in Medellin, and I remember that was one of my sister's favorite episodes because of the way that you opened the episode by saying, we're going to do this interview in 3 simple, fast steps.
Yeah, exactly.
My family really got a kick out of that. So thank you for doing that.
Sure.
But let's talk about what's going on right now in this crazy, crazy world. I think the thing that's kind of baffling me right now is the yield curve. And one thing that I find interesting, or at least the long end, and one thing I find interesting is that, and I don't know if there's any correlation. I'd love to get your take on it, but that the date where the 10-year started to go down, early April, coincides with the repo or the reverse repo spiking. The Fed was doing, where the Fed was the counterparty for reverse repo. So I just listened to an interview you did recently, and you think it's, or I don't want to put words in your mouth, but you're saying it's kind of, we had these inflationary expectations. They might not be panning out. That's what the long end is telling us. Do you think there's maybe more to it with what's going on with reverse repo, or what are your thoughts on the long end of the curve?
Well, to start with reverse repo, that gets into the whole world of funding markets.
Yeah, right.
And the one thing we do know about funding markets is we don't know a whole lot about them. And that includes Jay Powell too.
Right.
And so they are so complicated and they're so opaque. The reporting is very difficult. There's a phrase in that market called rehypothecation. I lend securities to you, you lend the same securities to somebody else, and we daisy chain them around. Right. Nobody knows how much of that's going on in the market. So anytime those markets get wobbly, we all get worried that there's going to be some cascading problem. And so that's where we are with those markets, in that we don't understand them as well. The Fed is very worried about those markets as well, too. What they've been worried about is the amount of bank liquidity has been soaring in the last few months. The Treasury has what's called their cash balance.
Right, the TGA.
The TGA, at the beginning of the year, it was about $1.5 trillion. Now, by law, the Treasury is only allowed to borrow what it immediately needs. They can't anticipatory borrow. They can't borrow for next year's numbers. They can't have a rainy day fund unless Congress approves one, which it never had. So what happened during the pandemic was they thought they would need a lot of money, and they borrowed like crazy, and they have like $1 trillion plus in that account. And then when they realized we borrowed too much, they started to run that account down.
Right.
Money at the Treasury is not part of the banking system.
Right.
When the Treasury runs that amount down, they push it into the banking system, creating excess reserves. The Fed was worried, and the markets were trading at a near zero interest rate, that eventually funding rates could go negative. Right. Negative funding rates in the US, that's a negative T-bill rate, a negative repo rate, is not good, because money market funds in the US are considered the safest instrument you can buy, because they have a net asset value of 1 every single day. You go below negative rates, they start losing money. And one of them would be at risk over time, period of several weeks of negative rates, that they would produce a 99 cent NAV. And that was one of the hallmarks of the financial crisis in 2008, where the world opened up. Now, in Europe, by the way, it's a little different there, because their money market funds go out to 4 decimal places, and they don't promise you 1.00 every day. They do fluctuate like a regular mutual fund. So the Fed raised rates by
reverse
5
repo.
basis. Yes, repo. They reversed the rates. By the way, every single time Jay Powell raises reverse repo rate or lowers it by 5 basis points, it says this is technical in nature and it doesn't matter for monetary policy. Usually everything hits the fans after that. Yeah. That's what happens, So we're kind of on the clock here, because they raised the reverse repo rate by 5 basis points to try and get these money market rates above zero. Problem is, everybody's piling in the reverse repo. They're like, wow, in a world of zero interest rates, I can get 10 basis points from the Fed and have the Fed as my counterparty. Look, if the Fed defaults on me, the whole system's done anyway at that point. Why don't I? So that's why there's almost $1 trillion in reverse repo right now. And the concern is that as more money gets sucked up into this Fed reverse repo, these are bonds that, again, you would lend and relend in the collateral markets. They're not there anymore. And that we might be running out of collateral. So there's a lot of concern in these funding markets that they might be, near some kind of a problem, or maybe in some kind of a problem as well, too. And the last thing I'll say about funding markets, I don't think funding markets cause problems. They make them worse. Just like in 2008, Lehman Brothers did not cause the financial crisis. It started without them. They just made it worse once we got to blowing up Lehman Brothers. So the funding markets won't cause a problem, but if one materializes, they could wind up making it far worse than it would be otherwise.
Yeah. And something I learned the other day, and I had a conversation with Jeff Snider, and I didn't realize is that when, in let's say a reverse repo with a money market fund and the Fed is the counterparty, when they get that T-bill as an asset in the transaction or collateral in the transaction, they have to keep it. I didn't realize that. It's not like doing a repo or reverse repo in the normal private market where that, let's say a term repo for a month or something, that collateral can be rehypothecated. So what we were talking about is the collateral multiplier on treasuries that are on the Fed's balance sheet are basically one, where the collateral multiplier on a T-bill that's out in the open market in repo could be 5, could be 10, could be 30. For all we know, and that's a big deal. And that's probably why Jeff was his hypothesis was that's most likely why the Fed hasn't bought more than, I think it's 300 billion worth of T-bills, because they know that they're taking that really good collateral out of the system. Go ahead.
I agree, and I throw out one other thing too. The TGA account is still, last I looked last week, it was around 600 billion in change.
Yeah.
Ideally, the TGA has to get to 300 billion. Remember that rule. The Treasury can only borrow what they need, not what they anticipate they might need at the end of the year. So if they're going to keep pushing another 300 billion out into the banking system, then the amount of T-bill issuance is probably going to start to fall a little bit as well, too. And then, you're going to really have that
more supply issues.
Yeah, more supply issues. People are going to be looking to borrow that money because, remember, T-bills are a cash substitute. In this world, when I need to pay you, what I could do is I could borrow T-bills and pay you. Is what I could, borrow T-bills from JP Morgan and send them to your bank to pay you. So we use them as a cash substitute. And that's why we need the liquidity of that system to flow, because it's cash is what it is. It's viewed as a cash-like substitute. And if we wind up having stoppages or liquidity problems in it, then the whole payment mechanisms in that market could really start to cause problems in the wider economy as well, too. We don't have those now, but those are the concerns that we have going forward.
Yeah, and I want to give people some context. You talk about the TGA going down to 300 billion. Prior to the GFC, pull up a chart. The TGA would hover right around 4 billion. 4.
Right.
Not 40, not 400, 4.
Well, keep in mind that the Treasury has said that the TGA should keep immediate cash on hand. That has been defined. Remember, this is the federal government's checking account that they pay everything from.
Right.
So they need to have about 2 weeks worth of money on hand in that account. Pre-pandemic, pre-crisis, when the deficit, we used to think the deficit was huge at 250 billion.
Yeah.
You could have 4 or 5 billion for 2 weeks. Today, the deficit is considered to be no big deal at 4 trillion, trillion with a T, and we're talking about MMT. That's why it's up to 300, or that's about where they've targeted it as well. So they might run it down a little bit more because the debt ceiling is going to end at the end of this month.
Yeah, well,
And
remember
then,
Yellen said, I don't know if you saw that. She said she came out and said that they need to raise it like ASAP or they're going to have big problems. And I said,
right,
man,
because
raise it, but there's still 700 billion in there or whatever.
right, they need to raise the debt ceiling because it isn't August 1st that everything stops because they could still run down the TGA. My favorite is the federal government can borrow against federal government employees' pension funds to fund the government. As a private corporation, try and do that when your company's in trouble. I'll just take the money out of the pension funds of my employees.
Yeah.
Everybody's in leg irons by the end of the day if you try and do that in a private
Yeah.
corporation.
Yeah. It sounds like
But in the
Enron,
government,
right?
yeah, exactly. But the government, it's just sophisticated monetary management is what it is when they do it. As well. So somewhere October-ish, September-ish, and it's kind of a made-up number anyway. They'll hit the debt ceiling, and then Congress will have, a decision to make. Does the government shut down, or do they raise the debt ceiling? Last thing, if I could throw it on the debt ceiling, we've had to raise it 100 times in our history. We started the debt ceiling at World War I. Prior to World War I, every time Congress wanted to issue a bond, that bond used to come to every time the Treasury wanted to issue a bond, that bill, which was the indenture of that bond, had to be voted on by Congress, every single bill. And so in World War I with Liberty bonds, that became too much. They'd have to vote on 4 of these a day. So they just instituted the debt ceiling. For the first 60 or 70 years, when we ran over the debt ceiling, you know what we did? Nothing. We ignored it. We just ran over the debt ceiling. They kept borrowing. It was technically against the law. Nobody cared. Then under Clinton, they decided, hey, we could use this thing to threaten nuclear Armageddon, shut down the government and everything. And then in 95 under Clinton, we had that famous thing where they shut down the government and they shut down the National Mall, and a bunch of Boy Scouts rode in a yellow bus for 12 hours and wanted to walk to the top of the Washington Monument, and it was chained up closed, and they were on TV crying, and that's it, the world's ending because the Boy Scouts can't walk to the top of the Washington Monument. And that's when the debt ceiling became a thing as well too. And we'll see if it remains a thing when we get to September or October, because it's all Democrats now. They don't need a Republican vote to raise it if they don't want a Republican vote to raise it. So we'll see what they wind up doing with it. But the bigger issue here with all of this funding markets and everything like that is we don't have a problem now, but they're so opaque, and we're pushing the outer bounds of what we understand with these markets that it wouldn't take much for a market that is not a problem to quickly become one in very short order.
Yeah. And what's bizarre is, and correct me if I'm wrong, but I believe the T-bills, like the 4-week bill, the 3-month bill, is trading under reverse repo. It's like 3 or 4 basis points, and reverse repo is 5. How do you work that one out when you could just give the Fed the liquidity for 5 basis points, and you'd still get the Treasury as collateral? Again, you can't rehypothecate it. So maybe that's what the issue is about, is that the primary dealer banks, by owning those T-bills at 3 basis points, can do whatever they do and make an extra 20 or 30, which would be above and beyond what they could make in IOER.
Right. And in the meantime, a bunch of unlevered money market funds, which are the huge buyers of these, are looking around and they go, well, I could get 5 basis points with the guarantee of the Fed on the other side of my trade, or 3 in the guarantee of who knows what on the other side of my trade. I'll take 5 all day long. Thank you very much. And and remember, that's a fixed number, so that number doesn't vacillate. If the reverse repo, that's set by the Fed. So that doesn't vacillate with market conditions like T-bill rates though. But you're right. The 3 basis points, because they can rehypothecate those markets, and because there's such a lack of liquidity that they can get a bit of a premium for that they'll accept that smaller rate as well too, because they make it up with all of that plumbing, as we like to call it in the markets.
Do you think the economy now is addicted to stimulus, or let's say government deficit spending? Because when I look at QE, it seemed, at the beginning, okay, we're going to do QE, but we're not going to call it QE1 because we're only going to need to do it once. And then you get QE2, then you get QE3, and then you get QE infinity. And now, what we thought were just astronomical numbers maybe even 5 or 6 years ago. Now that's just kind of, oh, they're doing 120 billion a month. Whatever, no big deal. But it seems to me like now we're going down that same path with deficit spending, that's the new, kind of, we went from this Fed put to where we had to have more and more and more and more QE. And if you pull it back, all of a sudden the stock market's going to tank for who knows whether that's just psychological or because of liquidity or who knows why. But it seems to me like we've moved from that to where we need that. But now, in addition to that, we need ever growing amounts of deficit spending and stimulus. What do you think about that?
Yeah, so let me not mince words here. Let me start big picture. Between 2010 and 2014, I went to a number of speeches by officials, both government officials, Federal Reserve officials, read a lot more of their speeches, maybe got to talk to a handful of them along the way. And their message was very clear. We think we did the right thing in 2008, but we recognize that it was viewed as a bailout of the rich. In fact, we had the Tea Party movement, which I like to say was angry about the bailouts and blamed the government. And then we had Occupy Wall Street, which was angry about the bailouts and blamed Wall Street. They were both angry about the same thing. And they would matter-of-factly say, and I'm kind of summarizing all of them, that the next downturn, we're going to have pitchforks and torches in the streets. So in order to prevent that to happen in the next downturn, we're just going to have to open the windows and throw money at everybody to basically satiate them. And that's exactly what we did during the pandemic, is that we ran this massive stimulus program where we just, extra $600 a week if you're unemployed, now $300 a week, stimulus checks left and right, $1,200, $600, $1,400, all these other programs. Now 39 million people get $300 a month for a kid.
I was going to say the child tax credit. Yeah. Yeah,
exactly. So we've been throwing money at everybody. And now their big debate is nobody wants a job, right? There's people that are begging people to come back to work, but nobody wants to work. And we're surmising that maybe we're just paying people too much to not work. And that's what's been happening. So the economy seems to really want that. The government, the federal government officials, elected officials, they want the stimulus. They don't want the pitchforks and the torches in the street complaining that we're unequal, that we bailed out the rich. Now, that's to be different from cultural protests that we had last year. These would be more economic protests as well, too. The Fed, the market, I want to say the economy is not addicted to the Fed. It's more addicted to deficit spending. The markets are addicted to the Fed. And I've had this conversation with a number of my friends that, the stimulus that you have from the Fed has been a big support of markets. And they say, oh, you're overstating it. And I was like, okay, really? Let Jay Powell walk to the mic right now and say, effective immediately, no more buying of bonds. Let's see how the markets react.
Our balance sheets are going back down to 800 billion where they were prior to GFC.
Yeah, exactly. Make that announcement. Watch what the markets do. So they're very addicted to this money as well, too, almost to the point where nothing else matters.
Right.
Because if you look at the economy right now, and I know we'll get into this a little bit, maybe now, maybe later, you can make the case that there's serious evidence that the economy is slowing. The Delta variant might be a problem. There might be economic restrictions coming. And I see new highs at the stock market, and I see very low interest rates. And you could cynically say, well, yeah, because if I buy stocks or if I buy the market, if you will, there's one of two outcomes. These companies get earnings and perform and justify my investment, or Jay prints a bunch of money and forces it into the market to levitate them to justify my investment. So when you tell people, hey, things might be going south, their attitude is great. He'll just print more is what he'll do. Or if you say things are going well, then you'll say, oh, good, then we'll get earnings to support why I bought it in the first place. So we're kind of caught in that mentality right now. It all comes back to 2014, right? They learned the lesson from 2008. They cannot be perceived as bailing out the rich. So we throw money at everybody and we satisfy what the markets want. And then we have a debate as to whether or not we actually have inflation or if it's transitory as well, too.
Yeah, you know what's bizarre to me is let's just say, quote unquote, the market has so much confidence in the Fed, like what you're saying with that Fed put. But then if you look at the explicit intent, and I'm going off of research I've done with the Bank of England and videos they've put out on YouTube and a paper they wrote back in 2014, the explicit intent of quantitative easing is to lower interest rates in the real economy, i.e. like the 10-year treasury. But if you look at every single time, that in 2020 is no exception, that the Fed came out with more quantitative easing, interest rates went up. They did the complete opposite of what the Fed wanted them to do, or the explicit intent of QE. So to look at that and then say, oh, well, the Fed is good enough to just have this Fed put to where it can control and it can make the market levitate, and to people actually put money and bet on that, it just doesn't make any sense to me when they can't, when the QE did the exact opposite of what they intended it to do. Or maybe it didn't. I don't know. I was just going off what, the Bank of England was saying. QE is supposed to lower interest rates in the real economy. And here it did the exact opposite every single time.
You're right. That's exactly what happened. But a couple of other things happened at the same time. Every time they announced QE, equities went up. And the idea that the Fed had with QE or the Bank of England was, we, the Fed, will buy bonds and keep interest rates low. You, the private sector, you're going to try and go into something that's going to give you a return or a yield. So you don't want to buy government bonds at, one with a 1% handle on them. You want to buy corporate bonds, or you want to buy mortgage bonds, or high yield bonds, or equities, or push you further out the risk curve.
Right.
So every time they announced a QE program, I think what happened was they chased a bunch of private sector people out of the safe instrument into riskier instruments. Stocks went up. The Fed bought bonds. They went up because more people left the bond market than the Fed was buying, but it would have been a lot bigger without the Fed. So, so every time they did a QE program, they ran people into risky assets, and they rallied a lot. Now, what's different now is the scale. The scale is so much bigger. It's 120 billion a month, 1.5 trillion a year right now is what they've got. So maybe they finally found that scale of, we're going to buy so many bonds, we're going to hold interest rates, somewhat stable. I say somewhat stable. We're still higher now than we were at the beginning. We started the year at the 10-year note at 94 basis points, and we're at about 125 right now. I know we're down from about 180 from the peak in March, but we're still higher on the year. So they're holding those rates relatively down, and they're allowing everybody to basically run into equities and run into riskier instruments. And when the news gets bad, no one really runs out of it, except for maybe a brief moment last week when we got all worried that the Delta variant, we had one bad down day and the market rebounded because everybody said, fine, if we get a Delta variant, Jay's just going to print faster is all he's going to do. So either Jay's going to make me a profit, or these companies are going to get earnings and make me a profit. And there's no scenario where I'm going to lose money, which is in itself as a contrarian kind of worrisome. But right now, that's not a play. It's they're going to go up one way or the other is what seems to be in play. So that's what I think happened with the QE, is that they just didn't do it in scale. I mean, I'm not trying to approve of the QE. I'm just trying to explain it. They didn't do it in the scale, which is why rates went up, because they did. Every time they announced QE, stocks took off, and that was definitely the case as well too.
So do you think they could peg the curve if they wanted to?
The curve. Yeah, we're talking about yield curve control, and just so everybody knows what yield curve control is that's where the Fed comes out and says, we're not going to buy 120 billion a month anymore. Unlimited. We're going. It's all. Yeah, about we're going to. Yes. We're going to say that the 10-year notes yield is 1.25 or 1%, and we'll buy whatever it takes to keep it at 1%. Right. Now, we have yield curve control in two countries, Japan and Australia. And the record is somewhat mixed in both cases because the market is still larger than the central bank. When the market gets worried about inflation or some other thing, they've seen divergences on that peg, if you will, from yield curve control. And we famously saw it in March of last year. But the other thing that happens when you peg the market, and this is what the Fed's got to really be worried about with yield curve control. Look at the Bank of Japan. They started it in 2016. Their JGB market almost doesn't exist anymore.
Right.
Their
Yeah, like
60%
owned by the BOJ, isn't it?
Right. And like whole days go by where their 10-year JGB doesn't trade one time during the day.
Right.
So it's a managed market between the Bank of Japan and the Ministry of Finance and the biggest private sector player in Japan, which is the National Post Office. Which is the pension fund for everybody that works at the post office. They seem to play all of this stuff. But if the Fed is not careful, the history is if you want to do yield curve control and you want to say the 10 years pegged at 1%, people will give up their dealerships and bond funds will close and everybody will go away. And then the day that you want to stop pegging it, there's going to be no infrastructure there anymore.
Right.
Because why am I going to pay a bond trader to trade something that the government fixes the price every day for? There's nothing to do at that point. So that's what they got to be very careful. So I would argue, no, they won't do yield curve control. I think that they will recognize that is a short-term fix with a lot of long-term downside if you tried to do something like set the price of interest rates or set the price of credit like that.
Yeah, especially going back to what we were talking about at the beginning of the conversation with the dollar funding markets, the plumbing of the system needing all of that collateral. And I know we were talking about T-bills and now we're talking about treasuries and 10-year, but just, kind of lumping them all together, if 60% of that was on the Fed's balance sheet, what happens to repo? Obviously the infrastructure goes away, but if there's no repo, there's no dollar funding market. I mean, there's no reserve currency. There's no there's no global dollar monetary system. And that's a big problem right there.
To be more specific about yield curve control, they probably would not start by targeting the 10-year. They'd probably start by targeting the 2-year at 25 basis points or 20 basis points. Now you're getting close to the funding markets. And when you start taking a benchmark like the 2-year and you fix that, and then you have reverse repo and you fix that rate, all of a sudden you look around and go, well, I don't know why I need repo traders anymore. All these rates are fixed. I can have a secretary just do these orders for me at this point. Or better yet, I could have somebody just write a computer program and do them for me because the prices are all fixed. So there's no skill in trading these markets anymore. And then eventually, like I said, the infrastructure starts to get dismantled and they don't need the infrastructure in the funding markets to get dismantled. As you pointed out, that would be a big, big problem if it did.
Yeah. I hear a lot of people talk about how, well, you got to go into stocks because we've got reflation, we've got inflation. Some people think it's transitory, some people don't, but your hedge there is going to be stocks. But whenever I hear that, I always think back to 1972 to 1974, to where the stock market went down by 50% in nominal terms when we had the worst bout of inflation that we've ever seen in U.S. history, or one of them, in the modern history, I should say. So how do you view stocks as an inflation hedge?
You're exactly right that this argument you're hearing is 50 years old, that we made the exact same argument that stocks are the perfect hedge for inflation in the late 60s and early 70s. And you're right that on an inflation-adjusted basis, they got murdered between 72 and 74. And
even in nominal terms.
Yeah. Here's the thing. I've looked at the inflation-adjusted chart a lot. Inflation-adjusted stocks peaked in 1968. They bottomed in 1982, losing 70% of their value.
Right.
They did not take out the 1968 high till 1993. It took 30 years almost to take out that. Now, why is it that stocks turned out to not be a good inflation target? Because with stocks, with a company, you've got two sides of the equation. You've got your product, which you can raise your price on, and you've got your raw material inputs, either labor or materials that you'd use to make your product. Or capital too.
At 18% interest rates.
Right. And what happened is, what happened then, and what I suppose will always happen is your input costs, your raw material, your capital, your labor will go up faster than you can raise your prices. Your margins will get squeezed. You won't have a margin. You might even go to a negative margin, which is what some of these companies did, and you get murdered. So the argument that you make that stocks are a hedge is labor is going to go up in price and capital is going to go up. Interest rates are going to go up and raw material prices are going to go up. But don't worry, I can raise the price of my product faster than those prices are going to go up, maintaining my margin. It's never worked that way. The finished good product can't go, you almost never goes up faster than the raw materials, because the finished good product is dependent upon consumers purchasing it, and they're getting squeezed. They don't have the demand to watch those prices go up. Otherwise, if this worked, every country that's ever tried to inflate their way out, think Venezuela, Zimbabwe, the Reichsmark, whatever you want, all that would have worked. It would have always worked every time, but it never works that way because the raw prices go up and the margins wind up going negative. So if you get inflation, then I suspect that you would see a big squeeze in margins as we move forward from here. Yeah, and the PEs, right? PEs are dependent upon margin.
Right.
If you look at margins in PEs, there's a direct relationship with them. When you have big fat margins, you have very high PEs. When you have narrow margins or negative margins, you have very, very low PEs. It's a reason why the PE in the market in 1982 was 5 or 6. But now the PE in the market's in the mid 20s. And that's concerning because if we are approaching an inflation period, this market is not priced for that at all.
Yeah, but when you're talking about wages in the 1970s and that whole kind of domino effect, if you will, I'm thinking through what's happening today with the government competing with entrepreneurs for workers, and all these workers on the sidelines saying, well, okay, I was making, let's say $12 an hour, but now the government is paying me $20 an hour. So in order for Chipotle or whatever, I'm just throwing this out there, they're going to have to offer $20 an hour, $25 an hour, or something like that. And most people who don't have much experience with businesses think that, oh, well, that's no big deal. They'll just have to pay that out of their profits. The owner of the business is just some fat cat that's lighting his cigars with $100 bills. But they don't realize that most of those small and mid-sized businesses that are the growth engine of the U.S. economy, they run on like 5% margins, like sub 10% margins, very, very low margins. So there's not enough wiggle room in the profit in order to pay or in order to increase wages by, call it 80% or something like that. So how do you see that playing out right now, contrasting that to what we saw and what you pointed out in the 1970s?
Well, first of all, you're right on a couple of things. I think I'm right on this number. 75-ish% of the US workforce works for a company of less than 100 employees. And it might even be less than 50 employees as well, too. Yes, the big growth engine is everybody works for a small company, or the majority of people work for the small companies. And if you look at big companies that employ 5,000 people or more, they have not created a new net job since 1980, 41 years, because they employ technology and efficiencies and they reduce their overhead. GM, employs 1/7 the number of people now that it did in 1980 and produces more cars because it's all robots that make the cars. So it's definitely, when we talk about the fat cat, well, the fat cat's that guy that runs a company of, he might run a fast food place and that might be 50 or 75 people. And, he's probably has a decent living, but I don't think he's jetting off to Aspen in a private jet. He's not at that. It's not at that level. He's not launching himself into space. To talk about that, and stuff. So when you talk about, well, he could pay $20 an hour. Okay, if that's going to be the entry level job, then everybody else in that organization gets a raise. Because if you're going to pay the guy $20 an hour that walks in off the street, I'm not going to, and I've been here for 6 months. Why am I getting $21 or $22 an hour? I should be getting 25. Right. And the guy that was getting 25 has been there a year. It's like, why am I getting the same amount of money and he's been here half the time? I should be getting 30. And that whole scale goes all the way up and the costs go up. And what's the other thing we sort of believe about wages? I say believe because we've never tested it, that wages only go one way, right? When you raise wages to get people in, to get everybody back to work, you can't go back and say, okay, well, business slowed down, I have to cut your pay. That's very difficult. If you cut pay, you destroy morale, you destroy any kind of culture you have, you encourage people to look for other jobs. And what usually happens is your best employees find jobs because they're employable and you're stuck with all the unemployable ones as well too. So that's why companies are very, very hesitant to raise wages. So we're stuck right now in a difficult spot. We've got a labor shortage in this country. Because there's a lot of jobs that are going begging right now. Famously, back in May, a bunch of restaurants in St. Louis held a job fair, and they were advertising that they had over 100 jobs, and they all banded together in a job fair. 12 people showed up to the job fair. Yeah, and I know.
Or I've heard about companies paying people just to come fill out an application.
Yes, there's a Walgreens in my neighborhood, and they've got a little table there, and they say to sign up for a job interview, and they'll give you a gift certificate just to take a gift card, just to take a job interview and stuff. So they're trying to get people in the door. So this is unusual. We haven't seen this. I mean, you tell me, when's the last time we saw people begging for work this badly, that they're willing to pay people
begging for workers?
Workers, yes, that's right. Yeah. And to some extent, a lot of people that are unemployed, yeah, I should get a job, but maybe next week, because I could get a job anytime I want. So I don't feel a sense of urgency to get a job. Now, what's controversial about this is a lot of people think it's that extra $300 a week of unemployment. And 25 states, starting in early June, 25 states, all Republican states, ended the $300. And there's other 25 states that still offer it, and those are largely Democrat or blue states. The data on that's mixed. Now, it might be because it's only a handful of weeks, but if you look at the employment patterns in the states that ended the $300 versus the employment pattern in the states that didn't, there's not much difference. And if that's the case, what I think that means is all this stimulus money is people are out there with the stimulus money buying stuff. I want to buy stuff with this stimulus money, and they're driving demand, and they don't feel a need to get a job right away, that we're going to have to pay them more. And then now we're back to the argument about margins get squeezed and inflation becomes more non-transitory because it becomes more, wages going up and stuff. We're at the precipice of that now.
Their expenses went down too, Jim. Because because I always focus on the stimulus checks and the additional, transfer payments with the additional unemployment to the child tax credit. But what I tend to forget is the eviction moratorium,
right,
or the mortgage forbearance, to where, and I'm not saying everyone is taking advantage of this, but a lot of people are getting a lot more money than they made in 2019, but yet their expenses have been reduced by 40% because they don't have a housing payment.
Right.
So there's that as well.
And they save a lot of money. I have 2 adult kids. And I mean, the anecdote I'm giving you, I've heard repeated many times. They lived in New York City in 400 square foot apartments. Each one had their own apartment. And when the pandemic hit, they were like, this is boring. I'm stuck in this little box all day long. I can't even go outside. They gave back their rents and they moved back here with me. And when the stimulus checks came out, I didn't qualify for stimulus check, but my kids did. Okay, that's like giving me one. I didn't have to give them that money. The government gave them that money. And then, now they've moved back to New York, but they've saved a ton of money in the process, and they've got money right now. And their rents are a little bit lower because they went back, in April. And so, yes, their expenses went down. They've got more money, willing to spend a little bit more of it because they've been in lockdown for a year. And there's no urgency. They're both employed, but there's no urgency for getting another job right away I'm talking about anybody at this point, because there's always jobs available. So the whole dynamic of this market, the labor market, that is, I think has really changed quite a bit. And that could lead to margin contraction. And then there's one other thing I'll throw out in this other big picture too. And this really goes to boomer managers. And I'm talking to you boomer managers out there. And I'm a boomer. I think I'm a boomer. I'm a Gen X boomer boss there. People don't like the office. And they don't want to go back to the office. And we're having this debate about got to get everybody back to the office. And I've joked, and I'm in Chicago, so I'll use the example in Chicago, and it applies anywhere, right? We got Wrigley Field where the Cubs play, and there will be a game there this afternoon, and there will be 41,000 maskless people stuffed into there. The bars will be overflowing. The subway will be overflowing. The bars on Friday night in Chicago are overflowing. But then if you tell people, that big office tower in the center of the city on the 38th floor is your office, when are you going to go back there? Oh, it's a health risk. I can't go back there. Oh, but you have no problem stuffing yourself into 40,000 people in a baseball stadium and riding a subway train to get there. But that office tower is going to kill you. No, you don't want to go back. Because here's the thing. Everybody that says we got to get back to the office is usually in the upper echelons of the company. The office is structured for them. They like the office. It's for them. But the majority of people that work in your office are usually administrative, clerical, or operations. The office isn't anything special for them. They kind of liked being at home for the last year as well, too. And they don't want to go back. Yeah, they'll go back once or twice a week to have some FaceTime and see some meetings, but they don't want to go back 5 days a week. So we're going to have a real issue here as to why do we have an office? Well, it used to be that was where all the resources were to do your job. Now, look at you and me. The resources to do this are on our computer, if not our phone, as well, too. And we don't necessarily need that big, expensive office tower in the middle of a big, expensive city to do a lot of this work. So the nature of work itself, I think, is under a review. But the problem is too many boomer managers are like, no, we got to get back to 2019. We got to get everybody back to the office 5 days a week as fast as humanly possible. And you want to go back because you're in the upper echelons of the company, but not everybody else wants to. And if we get a rise in the Delta variant, you watch how these offices are going to become toxic again. They're going to become death traps, and no one can go back to it. And that can be hugely deflationary for commercial real estate. If everybody realizes they have way too much office space and they don't need as much because we go to some kind of hybrid version of working as well, too. It can be a big, big problem for the economy because commercial real estate is a big part of this economy right now.
How do you think the continuation of the transfer payments plays into what you were just talking about? And what I'm talking about is, making the stimulus checks, for lack of a better word, more permanent.
I think they already are. I mean, we've already sent out 3 of them, and we've got the child tax credit. I think, what I fear is if you look at the Delta variant, let me forget all the health issues for a second. The number of cases are rising about 50% from the previous day of the week because there's a strong seasonal day of the week. So if you look Monday to Monday, Tuesday to Tuesday, every week they're about 50% higher is what they are. Friday is the high day of the week. Sunday or Monday is the low day of the week because the labs are closed on the weekends. That's why you got to look at day of the week. As the Delta variant goes up, I fear politicians make the decision on cases. You could argue to me, hospitalization's down. We've got better treatments. The death rates, no more than the seasonal flu. Yeah, that's probably all true. But they're going to make the decision that first we got to wear masks. Then we're going to have restrictions. Then we're going to have rollbacks on the lockdowns.
Right.
Then we're going to have grumpy, unhappy people, and then their answer is going to be mail them more money, is what they're going to do, because they already said when the crowds get unhappy, just throw money at them. And so I think we're probably on a road to more stimulus, is where we're going to go. And for most people, what that means is, they're going to roll back. That means I don't have to go back to that office. I get some more money. I get to work at home. It's not
or you get
great.
to move out to the country where there's a low cost of living and not work at all.
Right, exactly.
And then what does that do to productivity? I mean, that's what I keep thinking about, because I was an entrepreneur until I retired in 2012. And one of the last businesses I had, a component of the business was a 40-seat call center. And I can tell you that there is no way. I mean, we could have run a call center with those, let's say, types of workers working at home, and we could have pulled it off, but the productivity would have been way, way lower, because that type of employee needs to have a manager hovering over them at all times. And for those of you who don't like that, hey, it is what it is. You know? So I think of all of these, lack of productivity. And then I'm someone that believes that the wealth of a society is not measured by the amount of dollars it has, but its ability to create goods and services. And just everything I'm hearing seems as though productivity going down, we're just going to be creating less stuff as a society, therefore becoming more poor.
Isn't that what we've been doing now? I think, if you go, there's shortages all over the place right now.
Yeah, right.
Because we're not producing as much stuff because of the lockdowns. We're demanding stuff because we've got money in our pockets as well too. Now, maybe some kind of a hybrid model might work. Maybe there's a way in 2021 that you can run a 40-person call center remote, with all 40 people being individually remote. It's up to the 2021 managers to try and figure out how you manage something like that.
Or babysit would be a better word, Jim.
Right. I mean, there's a lot of different ways, but it's going to be very difficult to get, because like I said, you can't tell me that 40,000 people stuffed in a baseball stadium is okay, but to go to that big office tower in the middle of the city is still verboten. There's only one reason it's verboten. You don't want to go there. You want to go to the baseball game. Is why that is. And there is going to be the problem. So how do you get people? I mean, I've already heard stories that companies that are requiring full-time work are paying premiums to people. There are paying premiums to people to come back to the office full-time. And therein lies problems. JP Morgan and Bloomberg in New York City, to try and get everybody back 5 days a week, and their big concern is, I don't want to ride the subway because it might be dangerous. Okay, we'll pay for a car. We'll pay you to take an Uber every day. Now we got an Uber shortage. No one can get an Uber in the whole island of Manhattan during rush hour because, hey, my company's paying for an Uber. And then you go on and you realize there's a surge charge and it takes 45 minutes to get an Uber for a 15-minute ride. And so it is becoming, the problems are not close to being solved right now when it comes to the economy. And all of this, again, is how do you solve this problem? How do you get people back to the office? Pay them more money. You got to pay more money. That's inflation, is what it really.
Yeah, so that's what I was going to say. So, one of the first questions I had, ironically, that I haven't asked you, and we've been talking for almost an hour, is, your take on whether or not inflation is transitory or not. But it sounds like you're saying you don't think it is you think it's here to stay for a while.
I do. And I find that the transitory debate on inflation, I am not in the transitory camp. I think that inflation is not transitory. And I think that when things get bad, especially with Democrats up and down the line, and I'm not trying to be partisan here, but their answer will be more stimulus checks as well too. And what I've argued about stimulus is, to date, when you ask people about stimulus, especially in the Democrat Party, they can give you a correct answer. We sent out stimulus checks and everybody won. The poor got something. The unemployed got a bridge to a job by getting some extra employment. And the rich, let's define the rich as anybody that owns an asset You got new highs. So everybody won. We mailed out checks.
Yeah, but everyone got
won.
the inflation tax too, which
right,
is the most regressive tax possible.
They're not seeing it as an inflation tax. They're screaming transitory. And what I find that's interesting about the transitory debate is those that say inflation is transitory will say, what's your proof it's transitory? And they'll say bond yields are low. And I'll say, well, that's not a measure of inflation. That's a market opinion that's also muddied up with other things as well, too. And those that say that inflation is non-transitory, like me, what do I lean on? Every PPI and CPI statistic I can show you that shows that inflation is becoming more and more problematic as we move forward from here. But as long as bond yields are staying down, and again, I think it's because there's this massive government stimulus, Fed stimulus, 120 billion a month, with the promise that there might be more. That seems to be driving the market. But the minute that there is a consequence, that we've sent out so much money and something bad came of it, i.e., we now think there's inflation, the bond market agrees, rates are going up. As soon as we get that, that's the game
72.
changer.
That's 72 to 74.
We don't have that yet. But now that might, the thing about the transitory, not transitory debate, it's not going to get solved next month. It's not going to get solved in September. You know, it's not, we're not just waiting for next month's CPI report and go, oh, another bad CPI report. That's it. It's not transitory. Even if it is bad, we'll still say it's transitory. I think what we're going to see is all of these transitory items that everybody talks about, like used car prices and airline tickets and restaurants that have soared in the CPI statistic. And they'll say, don't worry, they'll start to come down. They're right about that. But what they're forgetting is there's something that's been lagging huge and should start up, and that's shelter or home or owner's equivalent rent inflation.
Right.
That stuff hasn't moved. It is slow by nature, and every metric says that by the end of the year, shelter or owner's equivalent rent inflation is going to be a lot higher by the end of the year. So while your used car prices and your airline tickets come down, see, I told you that was transitory. Here comes shelter inflation up. That's a way bigger weighting in the CPI.
Yeah, it's like 30%, isn't it?
Yes.
Or close to
and all this other stuff is like 2%, but it's doubled. So it's got a big impact. So what I think you'll find happening at the end of the year is, okay, all that transitory stuff came down, shelter inflation went up, but inflation, it's still sticking around the high 2s to low 3s. Now, when I say high 2s to low 3s, some people go, that's not inflation. Well, that's actually a 30-year high if you were to get it in the, consistently in the high 2s to low 3s. And second of all, you got to look at inflation relative to something, relative to bond yields. A 125 bond yield, if we're in a 3% inflation world, is
negative yields.
Right. Big negative yields is not sustainable in the long run. If we were sitting here and I said inflation is going to be high 2s to low 3s and we had a 350 bond yield, so what? So what if inflation's 3%? Because we got a positive yield. That's the big problem, is that then you wind up having the risk of being a big move in rates. And that gets back to the beginning of the conversation with a levered market and funding markets and everything else. You introduce that kind of volatility and a big move in the bond market, and who knows what could happen then at that point. So inflation, I do think, is the game changer. And I do think it is not, it is non-transitory. It's going to stick around longer. But this debate about transitory or not transitory isn't going to get solved in the next 30 or 60 days. So we can continue to say it's transitory, say it's not transitory. Both sides can perceive that they're right. The stock market will say, well, until we prove it's not until we prove it's more permanent, any problems, the Fed prints more money, we're good, just buy stocks. But then once we get that perception that no, there's a real inflation problem and rates, and no one wants to touch the bond market because the yields are way too low given the permanence of inflation, then the game can start to change. But like I said, that ain't right now, but it could be before the end of the year.
Do you think that's when gold goes up, is when the market has that realization you were just referring to?
Yeah, either that or cryptos or some other alternative investment or alternative idea away from the financial system. Gold has been a very frustrating thing, to invest in. I'm not sure what drives gold anymore, whether it's a financial asset, a commodity, kind of both. It's a way to get your money out of the financial system, sort of, kind of, but it's been a very frustrating thing. But I would think that in that type of environment, you might see gold start to move higher. But right now, it's just kind of stuck in the mud as we move forward from here.
Yeah. All right, Jim. Well, I've kept you. I said I was only going to talk 45 minutes. We just keep going. I could have talked to you for another 2 hours there. That was an awesome conversation. As always, I appreciate your time. For my viewers and listeners who want to find out more about what you do, where can they go?
Easiest way is to follow me on Twitter at Bianco Research, or look me up on LinkedIn, or check our website out, biancoresearch.com. We're an institutional advisory firm, but I think your best bet is Twitter, because we do a lot of stuff on that space.
Awesome. Jim, appreciate it once again. I can't wait to do this in the very near future.
Thank you, sir.
Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist Live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, Luke Gromen, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, we'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.